What impact will inflation have on our economy? We're speaking with economist and investor Ron Knecht to get his thoughts. I'm David Grana, and this is Real Talk. Ron Knecht, thank you so much for joining us today. Really appreciate it.
Happy to, David, and it's good to talk to you again.
Likewise. Thank you so much. Likewise, I always enjoy conversations, and we've got the benefit of the fact that not only are you our former state controller for Nevada, but you're also an economist. So you can kind of give us an idea of what's going on in the market, make some heads or tails of what's happening in the economy, how it's going to possibly affect all of us. And my first question for you.
Remember one thing, like any good economist, I have two hands.
That is true. Isn't it, was it Harry Truman that said, bring me a one-armed economist, a one-handed economist, and I'll listen?
Yes.
Yeah, he was very frustrated by them. So
yes, he was right.
He was absolutely right. So first and foremost, I have to ask is if I watch the financial media today, the CNBCs of the world, Bloomberg, etc., I mean, one would think that the economy is great. We're reopening back up. Everything is just fine. What is your take on the current state of the U.S. and global economy at the moment?
Well, on the one hand, David, as you know, I've long been the gloom and doom side of things, looking out since the Great Recession of 2008 and onward, and following up on that. And unfortunately, I've been right on most of that. Now I'm dipping my toes in the waters of, well, maybe it's not all that bad. Maybe we can muddle through. So I will say that one thing that we know about the economy now and the future is it depends greatly on the COVID-19 course, the course of the COVID-19 variants and vaccines. If everything goes well, our chances of coming out of that better are pretty good. If the vaccines work, if we don't get too many variants, if the weather doesn't cause the spread to be too bad, and that's what we all hope for. I certainly do. But the other aspect of the COVID-19 is the government-ordered lockdowns. And that's what's really the problem. Here in Nevada, we have a governor. I served with him on the Board of Regents for Higher Education, and he's determined, unlike the Florida and Texas governors, he's determined to go for hard lockdowns for a long time. We'll see who's right. I'm hopeful that the governors in Florida and Texas are right, and that things will pick up and Nevada will be able to follow other states very soon. But really, it all depends on an external factor like that and the lockdowns. Right now, things have been surprisingly good. We were wondering how long bond yields would continue to climb. And guess what? Today, my $4 a day paper tells me on the front page that they settled back down yesterday. They're moving around a little bit, but they settled back down to close at 152. So that's good news when it had been up to 160 something.
And as we're speaking right now, this is it's at 1.538, so just under 1.54.
That's the 10-year Treasury that we're talking about.
That is absolutely correct. Yeah, and Yesterday we had the Treasury had the 10-year auction. It seemed to be, let's call it sort of a non-event. There was plenty of uptake. However, one of the comments made, and I didn't hear it repeated, it was just mentioned once on Bloomberg, is that one of the reasons why there was such a great uptake is because investors are keen on shorting the 10-year Treasury, which to me means if you're going to short something, you're in anticipation that the value will drop. And with bonds, the value drops, but the yield is going to increase. You and I don't know that, but I mean, let's look at some of the fundamentals in the market right now and what's going on. We have a $1.9 trillion stimulus package that has just been signed today by President Biden. We are essentially now with that at roughly the $30 trillion debt mark for the U.S. government. And our 2020 GDP was just shy of $21 trillion. So we are at about 150% debt to GDP in this country. What does that do for us?
Well, you know, back in 2009, two outstanding economists, Carmen Reinhart and forget her partner's name, wrote this fantastic book, This Time It's Different, basically making the point that throughout history in advanced economies and in early economies, when the publicly held portion of the debt for a government got past 90% of the GDP, certainly past 100%, everybody always said before, oh, this time it's different. We'll be able to ride this out. And never before have they been able to do it. Right now, we're trying to find out whether this time it's different because we have all these new policy and financial tools. And frankly, I've been a little bit skeptical that it's going to be any different this time, and I'm worried about that. That's been a big part of my pessimism the last dozen years.
Well, now let's look at those past dozen years, and if we look at it, the Fed did under Ben Bernanke did pump a lot of money into the economy, built up a great deal of debt. However, we had, well, one could argue we had a bull market or a growth period. Depends on who you ask.
We did, but it was really tepid.
Well, and in addition, we did not have a great deal of inflation during that period. We did keep it at or below that 2% target that the Federal Reserve has. Why do you think that is? I mean, is this sort of if you will, and I don't say the word in any malicious way, but is it a manipulation of the bond market with operations like Operation Twist, et cetera, that the Fed had executed?
Well, I think it's a part of that. In fact, either the Fed in the last dozen or 13 years has gone off into adventuristic territory to try to accommodate all of this, and it isn't going to work, or it is going to work, and we have some new standards and some new monetary policy tools to use. Essentially, one of the things that the Fed did, and this one was really important, in 2008, banks had very strict reporting and accounting and compliance regs when they made small business loans, especially the big ones. The Fed took most of that away and substituted a new policy called, what was it? Called ample reserves. Now, by this, they meant that the banks were free to have the reserve level, the new higher reserve level that the Fed wanted, but they could do it a lot of different ways. Traditionally, what they had done was make commercial loans to especially small businesses. And when the Fed said, you can do it however you want to, you can either use those commercial loans or, which, as I said, can be risky and which have a lot of reporting requirements. And to the extent you want to, you can substitute federal treasury bonds and agency bonds, which we didn't used to be able to do. You can do that. Well, guess what? The bank said, hey, this is a great deal, because if we basically make commercial loans, those people are risky. We got to be on top of them. There's lots of them. And we got to report to the Fed in some detail. If, on the other hand, we take the same dollar and put it into treasury securities or agency securities, chuck it into our, our Federal Reserve Depository account, the Fed gives us full credit for it. We don't have to mess with it. And by the way, we happen to get interest from the Fed that basically covers the interest we're paying for it. So what a deal. And that's what they've done. Just to give you some figures here, the 25 largest US banks currently hold 45.7% of their assets in loans and leases. A year ago, that was 54.1%. So that's a substantial chunk of their book of business that has gone out of the risky, so-called risky, and it is, private economy into the QE, essentially, that the Fed is practicing. And right now, by the way, those Fed Reserve Depository accounts total $3.15 trillion. And Mr. Powell at the Fed recently testified that the Fed right now is doing its QE at the rate of 1.44 trillion a year and can keep that up indefinitely. So right now it looks like this whole brave new world is working, but we shall see. So far, it's gotten us from 2008 to 2021.
I suppose the question that comes up is, how long can we keep this up for? Does the panacea, or this medicine, if you will, that we think is getting us from point A to point B, does it start to not work?
Well, it may well be that we can keep it up for a long time, but let me tell you the price of how it is working. Basically, Bernanke, the previous Fed chair, Yellen after him, and Powell now have all been telling Congress, have been telling the world, we can manage the inflationary risk here. All we have to do is, literally in 15 minutes, Bernanke said, we could turn up the interest rate and manage all of that. And that seems to have worked. If by working, you mean that they're keeping the interest rates down and thereby facilitating federal government spending that you've pointed out, the 100 and whatever percent it is this minute. But what we also saw, and this was something you alluded to, is that in the last dozen years, while we managed all of that and the world didn't explode because the federal government was overspending, while we did that, economic growth slowed down. Yes, it was, as President Trump used to brag, the longest recovery on record, and it was also the worst. So if we're satisfied with 1% per year real economic growth and no inflation, gee, we might go on for a long time, but that's not the economy. That's not the society that people want and that they know from the last 200 years. What we really are looking for is 2 to 3%, or maybe 3% or higher real economic growth. That's what our whole society is based on. And I would submit that a lot of the social dissatisfaction and social upheaval that you're seeing has something to do with the low employment, the high unemployment that we're experiencing, partly from COVID, but partly because we can't get the real economy working any better.
Now let's talk about inflation.
Other than that, by the way, how was the play, Mrs. Lincoln?
So, by the way, this has to be the most depressing interview for anyone watching it. This is for nerds like you and me. We completely eat this up with a spoon. But I think for others, they're going, "Oh my God, why did I tune in?" But let's talk about inflation for a second now. If we look at, I know the CPI figures came out, I believe it was yesterday, which coincidentally was on the same day as the Treasury auction. And they were, let's call it, within line. However, of course, they don't include energy, which has shot through the roof. And by the way, I mean, I'm just going to give you an anecdotal example, but I can hear these examples all across the country. I paid $3.20 something odd cents a gallon for gas last night when I went to go fill my car. And I know that if you go to California, you're getting close to $5 a gallon. And I know some of it may have to do with the Texas, the issue with the Texas winter storm, but still, we're seeing that climbing. Food prices are going up. In fact, most commodities seem to be going up, with the exception of gold. For some reason, gold seems to be, everyone's putting their money in Bitcoin instead of gold, but the low inflation story doesn't seem to jive, and it only seems to jive with the official numbers, which tend to very conveniently not include things that very, very definitely impact our everyday lives, such as energy, such as certain foods, etc. So are we kind of lying to ourselves that there's low inflation, and are the numbers maybe... And again, I don't say this is being done maliciously. Maybe it's done for some reason or another, but are the numbers maybe not accurate because we're hoping there to be inflation because we think inflation equals growth?
It may be that the numbers are accurate in as far as they go and what numbers you choose and what they stand for. One of the points that's been made is that the inflation effect and the job loss effect, the unseen, unmeasured inflation effect, hits most hardest at the low income and poor people. Especially that's true with job losses. They're feeling the brunt of that. So hey, people like you and me and the people who are much more well off and richer than we are having a ball, maybe shorting the 10-year bond or who knows what. And how nice for them. But the people who go to the market every day to buy groceries and necessities are feeling it a little bit harder.
I also have to wonder this, and this is, I remember a conversation I had back in 2008. I was talking to a gentleman that worked for a endowment back on the East Coast. He and I were having a chat, and this is right after all of the governments around the world started to use their tools to be able to combat the global financial crisis.
Let me interrupt you just 1 second. While you're mentioning all the governments around the world, things have been working somewhat better here than they have been in Europe. So they're facing similar and the same problems, but It's really bad, especially for the low income, especially for the private businesses, for the people who are self-employed and that sort of thing. Go ahead. I'm sorry.
No, and by the way, to your point about Europe, yes, absolutely. I know that Christine Lagarde was speaking this morning. It sounded to me like she was just, if you will, kind of playing psychiatrist to the market, trying to calm everybody down. Nothing to see. Everything's just fine. Meanwhile, Germany is possibly going to another lockdown because of some of the UK variant. Italy is possibly going to another lockdown because of the UK variant, which apparently, at least according to some studies and reports, is deadlier than the original COVID strain. But going back to the inflation discussion. Inflation's great for anyone that owes money.
Right.
And I know that Chair Powell has said, well, we want to be at above 2%. Does that not benefit the US government to be able to see a spike in inflation so that their payback, especially on 150% debt to GDP, does that not help them out a little bit?
I think there was one little figure you forgot to mention. The US government is the largest debtor entity in the world and that the world has ever seen. Of course, it benefits them. Well, hey, for the people who aren't us, sorry for them. But yes, that part of the deal here is, and this was typical government behavior. Part of the deal is that the government will look out for itself and will look out for the things by which it's going to be judged. And things by which it's going to be judged include inflationary increases in government spending. And right now, you don't even have to adjust for inflation. The nominal increases in government spending are just ridiculous. So that's what they'll be focused on.
And at the same time, though, real returns are depending on what you own and how much you are getting on the nominal return. Real returns can, in some cases, be zero. Inflation expectations traditionally are measured by the spread between the 10-year tips and the 10-year Treasury, which is above 2%. I think it's about just shy of 2.25 as we speak right now, which means that is the expectation. So if you are earning, let's say 6%, you actually really only getting around 4% return on your investment.
I have a number of times run out the data series and graphed those two against each other. And that is a pretty good expression of the expectation, but it changes rapidly at times. So those expectations can change. But yeah, I think that's where we are.
So we're in an interesting position, or I should say the Fed is an interesting position, but it affects us, which puts us in a very precarious position. You have a Fed with a mandate to target inflation above 2%. You also have a Fed which since the 1970s, since the days of Paul Volcker, had the target or the goal to have maximum employment in the economy. Those two don't seem to be able to coincide very harmoniously with one another. So how is the Fed going to be able to maneuver this? I'm curious, or are they able to?
Well, let me say one thing in their defense at the moment. The unemployment situation is not wholly endogenous to the finance and financial and monetary policy. As we pointed out, it's exogenous greatly to COVID, et cetera, and more especially to the public sector policy response to COVID, the lockdowns, et cetera. And so you can give them a little bit of leeway there on that. On the other hand, in America, not Europe so much, but in America, the jobless problem is going away or being accommodated slowly, which would seem to be a measure of how well they're doing. What I pointed out a little bit ago is that in courting inflation risk, they are putting at risk those working people that they're supposed to keep employed also. So the Fed is doing some, for 10, 14 years now, has been doing some very new things. And gee, isn't it great to live through a major policy excursion where you're the person being tested on? I hope your assets and mine aren't the ones that are in a bubble right now, but we'll see.
Which it's a great segue to my next question, which is what everybody's wondering. And by the way, I speak to pension fund managers, I speak to wealth managers, people that manage money, and they all tell me, I think the market is a dangerous place to be in, but I don't know where. And by the way, when I say the market, I'm talking stock market, real estate, whatever it may be. But they also say, I just don't know where else to stick my money because you can't put it in a bank because you get zero. So are we in a bubble?
We're certainly in a bubble in some things, as you just pointed out, and I did. The trick is to know which ones are in a bubble and which ones are very solid and reflect real lasting value. A year ago, I committed some of our market, especially bond assets. I took them out of the markets and put them into a private investment, which was basically a debt investment. And I won't brag too much, but good grief, that did wonderful because of the interest rate that I was able to secure. Guess what? Come to the end of the year, well, that private investment has done okay, done well, but our equity portfolio, which is mostly mutual funds, almost completely, had only gone up 38%. Gee, I wish I had left some things there. So don't ask me to tell you where we're going or even where we are. Just ask if I got lucky, and I did. So I guess, yes, we're in a bubble. And as my own experience shows, with real money, my family's money, like most economists, like most policy analysts, like most financial people, where will we be next year? I don't know.
And interestingly enough, if you ask anyone about whether or not assets are valued correctly, that has completely gone out the window. Price discovery on anything, pretty much, with the exception, by the way, of commercial real estate. Strange enough, that seems to be priced somewhat relatively well, which is not very high, depending on the asset. But for the most part, price discovery is just almost non-existent because of so much money in the market. So I suppose the big question I ask is, will some of us get caught? And I'm going to use an analogy that a guy listened to, Peter Schiff. I don't know if you know who he is, but he kind of likens the current market to this. We're all having a wild block party. The music's getting loud. The alcohol is flowing. And we know the police is coming at some point to break it up. We just don't know when. Yep. So the smart people are going to go home at a decent hour and say, I had my fun. This is great. I'll see you next year or whenever the next party is. But there's going to be a lot of people that are going to be sticking around when the cops show up to break this thing up, and some of them might even go to jail.
That's right.
Are we going to possibly see a lot of people, whenever this party does get broken up, ending up on the short end of the stick?
That's a serious worry, and you've expressed it well. Let me back that up in another sense. You know that I spent many years as a cost of capital expert witness in utility regulation and related things. And every good lawyer knows where to get the opinion he wants by hiring the right expert. But the deal I learned as I did this longer and longer and investigated further and further and talked with some of the other outstanding ones was this. There were basically 2 or 2.5 models, variants of each, but one was your discounted cash flow model, which purported to incorporate intrinsic value and reasonable expectations for the economy for the future. The other was modern theory dealing with CAPM and beta models and that sort of thing. And then there was kind of a hybrid, which was the realized returns over the years in that industry. But that one was separate. In any event, what you learned from doing a lot of modeling work, a lot of data chugging before big data was a thing, was each of them gave you a different look at the world, which was why it was easy for the lawyers to say, oh, right now the CAPMs, the beta models are high and the DCFs are low, so I'm going to go get this guy as my witness, and vice versa. And of course, over time that would change. And what that was to me was very sophisticated modeling and data that told us how little we knew about the future, when the cops are going to come, and essentially that the future depends on certain assumptions you make. In the meantime, you're just living it. It's all happening to you. So when I hear the sirens, you can be sure I'll be out the front door.
You and me both. I mean, I think I'm far too cautious to play at this game for an extended period of time, especially when it's as hot and as frothy as it is at the moment. Ron, I have to share this with you. When we started this interview, I looked outside, and in spite of this being a rarity in Las Vegas, it was gray skies, and it was actually, believe it or not, it was snowing. We had snow flurries outside. Since we're getting to the conclusion of this, it's actually bright and sunny outside. So look at what you've done already.
Glad I could brighten your day and everybody else's, because that's a very unusual thing for me to do.
Ron Knecht, thank you so much for this. I hope that we can talk again about what's happening in the economy and where we're at, let's say, in another few months. And I want to thank you so much for your time and your insights.
David, it's always a pleasure, and I look forward to a resumption also. Thank you.